Okay, so now as we progress forward and when we understood that the Monopoly board game on itself, we are sitting on a total world debt by 200 corporations, debt in itself, which is 250 to 300 trillion as of 2024, which is a rough estimate. And at the above graph, as you can see, as you can see, at this pie chart, under the estimated 250 to 300 trillion global debt, the influx of flow, which government debts of the corporation, it's 200 corporations debt, which is sitting on 1/3 of the total debt in the world, which is 34%. And on to the next, which is the corporate debt. Okay, these are all the innovations, corporates, or goods and services debts. Sitting on the third largest is the household debts, which is 55 trillion, and it's on mortgages, personal loans, credit card balances. And on the last, which is the financial sector debt, 17.2%, 50 trillion. Those are banks and financial institutions borrowing. Okay, as you can see from this global liquidity stack, from real assets to leverage value, and when we can see the real economy sits at the bottom, which is 100 trillion in productive assets, and the global debt, which is 300 trillion, which is the total global debt, the bonds, the loans, the mortgages. Okay, and on to the next one, which is the derivative net, which is a small in real exposure, is roughly sitting around 12 trillion, and the derivative gross, which is the balloon, the projected value, is on 600 trillion. So this is just a representing leverage bets and contracts referencing the underlying assets. So this shows how we get from the real debt to the 600 to 300 trillion leverage projection without it all being actual borrowing. Okay, so let's just go on to explain a little. Let's just say we start from the fourth one, which is the gross notional of derivative. So it's actually the total face value of all contracts outstanding. So you can think of it as counting the full amount of every bet in the casino. But even though most will cancel each other out. So the net value, the third one, is the real exposure after offsetting position. So that is much smaller. But how you can visualize this is at the base level, the real world debt, which is 300 trillion, and on the stack layer, which is the financial contracts on top of the debt. So you can think of as the traders, the banks, and institutions. They don't just hold the debt. They trade the derivative on interest rates, credit default swaps, or the future markets. So each of these contracts reference the debt, but isn't the full debt itself. Okay, that's how you get gross derivative notional of 500 to 600 trillion. So it's just a projection or multiplier of the underlying asset. Okay, so why 600 trillion isn't the real debt is because the big number is not money owned in reality. It's just the sum of all contracts face value. Okay, if you don't understand, you can ask ChatGPT. That will solve you a lot of questions that you can begin understanding. Okay, because when you ask a question, and bear in mind, when I started learning all this, there isn't ChatGPT, alright, and we learn things one pie or one picture by one picture or one topic and one topic. Eventually, it maps out part of the certain niche that we are trying to understand, and we can patch it up. Okay, so now you have ChatGPT. Oh my god, and it's so easy. Okay, and what is the net position is the real exposure, which is sitting around 10 to 12 trillion. But in theory, if the system flows and no one netted the position, the liabilities could spike. Okay, so that's the systemic risk people should worry about. Okay, so when you look at this graph now, okay, so this is the total global financial asset, which is 500 to 600 trillion is on the source. Okay, equity is just only one slice. Okay, so let's just sort of break it down as we are familiar into more uh, in depth, which we already know. The debt securities, which is the government and the corporate bonds, it's the estimated value. Okay, 140 to 160 trillion. So it's part of the 300 global debt figure, the total global debt. And on to the next, which is the loan and mortgages. Okay, 120 and 140 trillion. So these are all the bank loan, real estate loans, and the public equity. Okay, so later on, this which is sitting 100 to 110 trillion. Later on, I'll show you the market cap bubble chart. Okay, so on to the next, which is the private equity and private businesses, 60 to 30 trillion. These are not listed on the stock exchange. Okay, and real estates, residential and commercial, it's sitting around 320 to 350 trillion. So this is the largest asset class in the world. It still is because it is real estates. Okay, and the derivative, which is the gross notional, which means leverage product, on the face value is around 10 to 12 trillion. Okay, so it's not directly comparable. So most is net out, which is, as you can see at the bottom, which is the commodities, which is sitting at 10 to 15 trillion estimated value. Right, gold alone is 12 trillion. Imagine. Okay, so now you can kind of understand why people are only talking about, gold, real estate, and maybe Nasdaq, but most of the people wouldn't talk about investing or into the bonds or the government securities. Okay, so this is on to the next topic, which we'll go by, which is, do you still remember about the concept of currency, which is more tied to the currency, which will more likely be devalued because of the endless supply of printing? So now you can kind of have a rough idea why, like, certain things that are mentioned here, like gold or real estate. See, Bitcoin is not even in the picture. Okay, so it in itself exists in a different form in a different world, in the internet. Alright, so all this we will go by later on the next episode, which is a very in-depth breakdown onto which assets are more safe, which is not sensitive, devalued by the currency factor in itself. Okay, so let's just come back here. So the cash and deposits here are sitting around 60 to 70 trillion. This is all the bank's deposits and all the reserve. Okay, so now you kind of get where the picture and most things are right now. So now, as you can see, this is basically all the worst public traded companies as of 2025. Okay, so rising from 42% in 2023, the US makes almost half of the world equity market cap in 2025. Okay, so at the middle you can see it's America Dream, 60.1 market cap value, and onto the next, which is the EU, 12%, and on the third, which is China, 13%, and you have the next, which is India, 4%, America and Middle East, 4%, Japan alone, 5%, rest of the Asia is 6%, Australia and New Zealand is sitting at 1%. Okay, Latin America and the Caribbean is 1%, and Canada itself is 2%. Alright, so Canada, calm your tits down, and UK is at 3%. So understanding this, now you can know that now the influx of flow or the market desires are in between these top three regions. So you get the point right now why we are always talking about America, China, and Europe. Okay, the rest maybe here and later a little bit. Okay, but that is also not the reason why I'm always constantly referring to US. In the next episode, we'll go more in depth. There are things that are more interesting, but now, as of now, I'm trying to just give you a visual representative of the total global debt that has been moved outwards, and with the face leverage value, how it is that these countries that we are seeing right now, the top 10, which are, or the top 20, who is doing well in that sense, whereby it is providing circulation or influx of flow in the economy, and why they are one of the biggest powers in the world right now. And bear in mind, Russia is not even sitting there. Okay, so according to these top three, so on to the next, which is the top three global sectors by market capitalizations are, information technology, financials, and the industrials. So these three together account for about 50% of the global stock market cap. Okay, so let's just have a breakdown. As you can see here on the information technology, the market cap, okay, bear in mind this video is slightly going to be factuals and numbers. Okay, so sometimes there's just one episode, it's going to be this episode. Okay, where I break down most of all the market caps into one small video. And as you can see, it is the information technology is sitting on 20.25 trillion, financials 12 trillion. Look at healthcare, guys. So it makes sense, right? Whatever it's more important in the world, it has more market cap, more desires, more activities of money going into these sectors. And the next is consumer discretionary, 8 trillion. Industrials are 7 trillion. Consumer staples 5 trillion. Communication services 6 trillion. Energy is just 3 trillion, okay guys. Material is 2 trillion. Utilities is 2 trillion. Okay, bear in mind guys, these are just equity markets, okay. So what is equity markets? Is a collection of all stock markets around the world where companies issue and trade shares of ownership. Okay, so it's known as stocks or equities. So this market allows investors to buy and sell ownership stakes in public company, giving them a claim on the company's profits and asset. Okay, so just a few things. This includes exchanges like the New York Stock Exchange, NYSE, Nasdaq, London Stock Exchange, Tokyo Stock Exchange, Shanghai Stock Exchange, and the other countries. So these purposes are the companies raise capital by issuing shares, and investors aim to grow their wealth through price appreciation and dividends, okay. And on the global scope, because companies and investors operate internationally, equity markets are interconnected, okay. So events in one country like economic data, interest rate change, and geopolitical issues can ripple through markets worldwide. So it's basically types of stocks is large cap, mid cap, small cap. So depending on the company size and on the sector base, which is, as you can see, technology, healthcare, energy, or finance, okay. So there are emerging and developed markets. So in the sense, it's the same based on the country's economy. So indicators of market health and major indices like S&P, Dow Jones, FTSE 100, Nikkei, and MSCI World Index will track the overall market performance. So in essence, the global equity markets are the heartbeat of the global economy, reflecting the collective confidence of investors in companies and nations. Okay. So in a nutshell, after understanding the concept whereby the world in itself has a total world global debt which is around 250 to 300 trillion, and on to the next, which is the real estate, which is around 100 to 150 trillion, and on to the next, which is the equity and the stocks, is around, I can't really remember the number, which is the previous slide, the previous graph. These are all the emerging and the top influx of money going into these markets. So bear in mind, I have not even included cryptocurrency in it because it's a tiny fraction of what we just see in the major markets, okay. So with all this sentiment going, now you can understand and kind of visualize all the money that has been moving into these markets. So on the few future episodes to come, I will cover, like the money influx of flowing into these markets, which is important, why you can take note, why you can be interested in. But all in all, okay, stock markets, as the last note before we end this video, this topic, these are the baskets under stock or equity markets that you can put your money in, which most of the wealthy people, and you can understand why now, when the wealthy people have money, or the market in itself is favoring people getting into loans, into debts, and putting money into the futures, which is the emerging market, or the under these baskets of the biggest growth category. So here in itself, you can kind of visualize, currency in itself, it's devaluating because everyone who has cash take on the basic notion on the world debt of that pile of money and redistributing things into at least real estate or into stocks or into bonds or debts, the government securities. So later on, we'll go on into this subject where we will be touching on which are the more safer baskets where you can put your money in or where you can speculate basically. So without you understanding how many baskets are there, it is very hard for you to continue to visualize the market. But bear in mind, I think I already did a good job in just 4 videos explaining and showing you how the matrix is, how much the total board of the monopoly game, and where in it the money in itself are moving towards into. And from there, you can understand why, as much of being a monopoly player, having this much cash, and if you continue to go through the game with just cash with no assets, you are fucked in the ass, man. The only place you wish to be is in a prison, right? So that's why you always have this notion whereby people, or in Asia, people would, commit a crime and sit in the jail for free food at least. So now you get the whole notion of it, right? Why assets matters, okay? Why assets are one directional trajectory upwards, and currency in itself, not just devaluing, but it's onto the next step, which is debasement and the transitioning to come, whereby why Trump is issuing CBDC. These are all geopolitical conversations and topics. We can in the future go more, but as for now, maybe onto the next 2 or 3 videos, I'm pretty sure I've summarized the entire economics in the stance whereby if you look at this graph right now, on the top side everything relates to the currency, and on the bottom side everything relates to asset. So with this framework now you can have a proper guideline and understand where things are moving, where things are getting heated in the top of the chart side, which is the currency side, and at the bottom side, which is the asset side, why there are many noises and attraction or FOMO going on. And bear in mind, this is just a framework, and I haven't even put big cryptocurrency into the picture yet. So on to the next. Ciao, ciao.